How do banks and finance work? A banking system explained for beginners. Have you ever thought about how banks work? They don't just safeguard the money of the people, but also earn a huge profit by lending out the money to others. Banks have become a strong network, and their importance cannot be neglected. Hello 101 community, welcome back to our YouTube channel. In this video, we're going to explain how banks and the finance system work. But before we begin, if you're new here, make sure to subscribe to our channel and turn on notifications to never miss any updates. Banking explained. Banking is a type of business activity that accepts and protects the money of other people. You might be thinking about how accepting and safeguarding the money of others can become a lucrative business. The banks do not hoard the money of the customers. Instead, they lend out the money to others in order to generate interest, profit. Moreover, banks also provide other financial services, like the issuance of drafts, letters of credit, and locker facilities to individuals and entities besides just accepting and lending. If a customer deposits the money in the bank account, the bank pays very little or sometimes no interest to them. The average account interest rate is below the rate of inflation and not even 1%. For instance, you have $5 million and deposit the money in the bank account. On the other hand, if another person's applying for a mortgage to buy a house, the bank would lend the $4.5 million to the other person at an interest rate of 4%. Now you might have a question in mind about how a bank can earn a profit by charging a normal interest rate. Actually, the bank is getting $180,000 interest annually on $4.5 million. Basically, the bank is earning $180,000 of interest on the reserve money of $500,000. In a nutshell, the bank is earning a 36% return by lending the money to others. The banks offer different types of accounts according to the needs of customers. Checking accounts. Banks make checking accounts available to customers, which enable them to deposit and withdraw money for daily transactions. Normally, customers deposit their regular income in this type of account, and then they pay their living expenses through this account. You may have an idea about this account, in which you deposit the money through a check and withdraw through a debit card. Due to regular deposits and withdrawals, banks have to keep more money as a reserve, which is why you don't get any interest on checking accounts. This type of account is very convenient for customers because they're allowed to deposit and withdraw money as much as they want. In short, there's no restriction at all. Moreover, the banks also charge a nominal fee on this account. However, there are a few banks that offer nominal interest rates on this account as well. Saving accounts. There are many customers who don't want to withdraw their money on a regular basis. So banks also provide the facility of some other accounts like savings accounts. Savings accounts are used by customers who want to save some money for their future. These customers don't have any immediate need for their funds, but want to make sure they have access to their funds so that they can withdraw their money if they see adversity in their financial situation. The customers can get a good amount of interest rates on this account, but this interest rate is still lower than what they could get through fixed deposit accounts. Just like checking accounts, savings accounts also provide the convenience of withdrawing whenever you need the money. Some banks even try to attract customers by offering them a high rate of interest for a limited amount of time or cash to maintain a minimum for a particular time. If you liked the video so far, press the like button and subscribe to the channel. Also, if you want to develop yourself financially and want to take your future into your own hands, check the links in the video description. You can also support the channel by visiting our merch shop and buy one of our products. The link is also in the description. Let's continue with the video. Long-term deposits. Banks also allow their customers to deposit their money for a fixed term and offer a high amount of interest, even higher than what you could get in a savings account. This type of account is often suitable for those people who have plenty of cash in hand and want to earn more in the future. For instance, if you want to save money to buy a new car or house, or even if you want to save funds for your retirement, you must keep one thing in mind. You cannot withdraw the money from the bank before the end of the specified term. Now you might have a question about how long you can deposit the money in the fixed deposit account. The banks allow you to deposit from a minimum of 30 days to as long as 10 years. If you keep your funds in the account for the long term, you'll get more interest and vice versa. For instance, if you deposit a specific amount for a minimum of 30 days, you will not be able to get an interest rate that you could get by depositing the amount for 10 years. As a beginner, you should have an idea of asset liability matching, in which the banks try to match the terms of loans it makes with the terms of deposit it has. So if the bank is making a lot of loans with a 5-year repayment term, it may offer a higher amount of interest on a 5-year term deposit to attract more customers. When the banks gather the deposit that it needs, they'll automatically lower the rate of interest. The fixed deposit account is also known as term deposits, time deposits, certificates of deposits, or general investment certificates. Now you might have an idea that those banks, which have a good amount of deposits in current accounts, savings, and fixed accounts, can offer more loans to individuals and institutions. Bank and debit cards. The banks offer several kinds of payment cards to customers. Bank cards are also popular as a debit card that's linked with your checking account or savings account. It allows you to withdraw a certain amount of money through ATM machines, or you can also use your card to pay the bills, so you don't need to put cash in your pocket all the time. Federal Reserve Bank. You might have a question in mind. If the duty of the bank is just to accept and safeguard the money of the people, how can it earn a profit? Actually, banks do not just hoard your money. Obviously, this would not be beneficial for banks, and so they lend it out to the borrowers at a higher rate of interest. So another question comes to mind. If the bank lends out all the money to the people and businesses who are seeking loans, now if people who deposited their money in their accounts knew that their money might not be there in the emergency withdrawal situation, they would definitely raise the question banks are not the secure place to deposit their funds. Actually, banks are not allowed to lend out all the money they receive from their customers. They keep some money in hand, so in case customers need them in an emergency, they can withdraw on time. For instance, if you deposit $10,000 in the bank, you will not be allowed to lend out all the money to the business or the individuals looking for loans. Instead, it'll be required to reserve about 10% of the total amount and will be free to lend out the remaining 90% or less. So you might have a question about which institutions put these types of restrictions on commercial banks. The answer is Federal Reserve. Fractional banking is a popular form of banking that controls the circulation of money in the economy by printing notes and increasing or decreasing the requirement of the reserve. Imagine if there was no existence of the Federal Reserve in the country. All the commercial banks would make their own rules and regulations, which might not be in favor of the customer. Just think for a moment that if no bank is required to have a certain portion of the money as a reserve, they'll lend out all the money, and if you need to withdraw your money in an emergency, the bank will have nothing but to apologize. These kinds of activities will break the trust of the people in banks. Moreover, the Federal Reserve plays an important role in controlling inflation by increasing the rates of interest on the loan. That's all for today's video. I hope you enjoyed it. If you want to see more videos like this, subscribe to our channel and click on the bell icon so you'll be notified of every update. Also, don't forget to check the links in the video description. And while you're here, I'm sure you want to continue on the path of financial education. Click to watch the video appearing on your screen right now. I'll see you there. Take care and stay tuned.